Welcome back to Investing Talk Podcast.
Today, we're looking at Redcat Holdings.
As usual, before we start, subscribe, like, and comment to this video to support the show. And we really need to get right into why this particular company is generating so much heat on the institutional radar right now.
Yeah, there is a lot of heat.
I mean, we are looking at an organization sitting at an undeniably pivotal inflection point. They are right in the middle of attempting this massive transition from a gritty early-stage drone startup into a legitimate, reliable defense supplier.
Which is incredibly hard to do.
Right. And they are trying to pull this off in a macroeconomic environment where, frankly, global defense budgets are expanding at just a breakneck pace.
That transition from a scrappy startup to a prime defense supplier is notoriously the hardest leap for any contractor to make. You know, the focus of the broader market right now is entirely on their explosive growth trajectory.
Exactly.
But the real question for you, the listener, is how they are positioning themselves to capture a massive share of this expanding defense budget, and whether the strategic moves they're making can actually lock in long-term dominance.
And my role today is going to be checking the data and poking some holes in the hype.
Good luck with that.
Well, it is incredibly easy to sell a narrative in the defense sector, especially with the macro tailwinds we are seeing. But execution is where these companies usually stumble. Wall Street is full of hardware startups that promised the moon and just, ran out of cash.
Oh, absolutely.
So let's open up the ledger and look at the fundamentals. Because the revenue growth projected for 2026 is, frankly, it's massive.
Yeah.
But I really want to know what is actually underpinning those projections.
Well, management is heavily messaging that 2026 is going to be their breakout year. When you look at the communications coming from leadership, specifically CEO Jeff Thompson and COO Chris Erickson, they are hyper-focused on this exact transition phase.
Right, going from prototype to production.
Exactly. Erickson has been very vocal about moving into an era of reliable supply, and that is a crucial phrase. The Department of Defense doesn't just want cutting-edge technology that works in a vacuum.
No, they want to buy a supply chain.
Right. They want to know that if they order 1,000 units, the manufacturer can actually deliver them on time at a consistent quality and with stable pricing.
That brings up a great point because a couple of engineers can build 10 amazing drones in a garage, but that doesn't win you a Pentagon contract.
Not at all.
Scaling a hardware business is notoriously brutal. I mean, Elon Musk called it production hell for a reason. So how is Redcat proving they can actually scale their orders to meet that kind of institutional demand?
We are already seeing the proof in the preliminary data. Their preliminary Q4 2025 results were highly positive, demonstrating that they are successfully scaling these operations right now.
The rubber is meeting the road.
Exactly.
Yeah.
And the major upcoming catalyst for anyone watching this space is March 18th, 2026. That is when the official Q4 and full year 2025 results drop, which is going to give the market a definitive look under the hood.
That March 18 date is definitely something you need to circle on your calendars. But beyond just the top-line revenue, I always look at financial health and capital allocation.
Always follow the money.
Exactly. How a management team spends its cash tells you everything about their internal confidence. And Redcat is explicitly avoiding dividends or stock buybacks right now.
Which is exactly what they should be doing.
Right. Normally, investors love a dividend. But in a high-growth phase, you want to see a company aggressively reinvesting every spare dollar.
And they are aggressively reinvesting their cash, but it's where they are putting that money that actually matters. They are focusing heavily on multi-domain expansion.
Multi-domain.
Yeah, they aren't just sticking to flying drones. Through their subsidiary Blue Ops, they are pushing hard into unmanned surface vessels, or USVs.
So we're talking about autonomous tech operating on the water, not just in the air.
Because the future of modern warfare is entirely multi-domain. It's an ecosystem where aerial drones are communicating directly with autonomous vessels on the water. They're sharing real-time data and coordinating actions without human bottlenecks.
I see.
By pumping their capital into Blue Ops, Redcat is trying to position itself to sell an entire interconnected ecosystem to the military, rather than just being a vendor for a single piece of hardware.
Okay, but an ecosystem only works if competitors can't easily replicate it. So I want to unpack their competitive moat, because the corporate structure seems highly specialized. Break down their subsidiary ecosystem for us.
The foundation of their manufacturing moat relies on two key subsidiaries, Teal Drones and FlightWave Aerospace.
Okay.
Through these two entities, they manufacture very specific Department of Defense-approved hardware. The two standout products driving the narrative right now are the Golden Eagle and the Black Widow drones.
Those sound like serious pieces of equipment. What
Yeah.
makes them so special compared to the standard commercial drones we see literally everywhere?
Well, these are small, unmanned aircraft systems, purpose-built for military applications, specifically short-range reconnaissance and strikes. They're hardened against electronic jamming, they're built for harsh environments, and designed for secure data transmission.
The hardware sounds solid, but honestly, technology can always be reverse engineered or leapfrogged by a competitor with a bigger R&D budget.
Usually, yes.
Right, but from my reading of the data, their true competitive moat isn't just the drones themselves, it's a massive regulatory tailwind. I'm talking about the fiscal year 2025 National Defense Authorization Act, specifically Section 1709.
Yes, that is the linchpin.
I need you to explain to the listener exactly what this does, because on paper, it looks like a legally enforced monopoly.
Section 1709 is an absolute game changer for domestic defense manufacturers. Essentially, it restricts foreign competition by outright banning the use of non-U.S. components in certain defense procurements. For years, the global drone market was flooded with incredibly cheap foreign-made components, everything from the physical motors to the cameras to the flight controllers. The new NDAA regulations state unequivocally that the U.S. military cannot buy drones containing these specific foreign parts.
That sounds like a complete supply chain nightmare for about 90% of the industry.
It is.
It's basically like trying to build a modern smartphone, but you're legally banned from using any microchips from Asia.
That is a perfect analogy. It is an incredibly heavy lift. Building a supply chain that is 100% domestic, or at least sourced entirely from allied nations, requires years of relationship building and significantly higher upfront costs.
Which most startups simply cannot afford.
Exactly. But Redcat essentially saw this coming and already did the hard work. By securing a compliant domestic supply chain early on, this legislation hands them an incredible structural advantage. It completely removes all those undercutting foreign competitors from the bidding process.
Which instantly boosts their pricing power and expands their profit margins. I mean, if the Pentagon needs a drone, and legally they can only buy from a handful of fully domestic suppliers, Redcat is sitting in the driver's seat.
They absolutely are.
But do they actually have the contracts to back up this advantage?
They do. They have secured major contract wins that really cement this moat. We're talking about the Army's short-range reconnaissance program, the drone dominance contracts, and their highly coveted blue UAS status.
Yeah, I see this blue UAS sticker thrown around a lot on defense forums. Is that just a marketing gimmick, or does that actually move the needle for procurement?
Oh, it moves the needle. It is the absolute gold standard for government procurement. Blue UAS is a highly exclusive list maintained by the Defense Innovation Unit.
Okay.
If a drone is on that list, it means the hardware and the software have been thoroughly vetted for cybersecurity vulnerabilities and supply chain integrity.
So they don't have to start from scratch every time they sell to a new agency.
Exactly. It means any federal agency, from the Department of Defense to the Department of the Interior, can buy it off the shelf without having to conduct their own months-long security audits. It is a literal fast pass to federal procurement dollars.
So they have an impenetrable legal moat, locked-in DoD contracts, and this fast-pass procurement status. Let's pivot to the charts for a minute, because I'm assuming Wall Street has caught wind of this. Looking at the ticker, the price action seems to be front-running this exact narrative.
The recent moves on the chart have been nothing short of explosive. If you look at the daily price action, on March 2, 2026, shares skyrocketed over 17% in a single trading session.
Huge move.
And they didn't consolidate or give it back the next day. They extended the rally by another 8% on March 3, hitting their highest levels in over a month.
Zooming out to look at the broader technical structure, the stock is up over 60% year-to-date in 2026. Breakout momentum is clearly established here. The chart is making a relentless series of higher highs and higher lows.
The trend is undeniable.
But we need to address the volume, the options flow, and specifically the geopolitical catalysts driving this massive influx of capital.
Right. Geopolitics is the primary engine behind this specific sector rotation.
And just looking at this purely through the lens of market mechanics, setting aside the politics of the Middle East conflict, or validating any specific actions when rhetoric heats up between the U.S., Israel, and Iran, capital aggressively rotates into defense.
We are just looking at capital flow.
Exactly. We are seeing leaders use phrases like sustained campaigns and unlimited munitions. From a purely quantitative standpoint, How does that translate to the tape?
From a market mechanics standpoint, escalating geopolitical conflict drives immediate, aggressive demand for defense technology. When institutional investors hear unlimited munitions, they immediately start reallocating capital.
They don't wait for the official orders.
Never. They are front-running the inevitable massive government purchase orders required to replenish stockpiles and arm new defense initiatives.
And Redcat is clearly riding the crest of that wave. We are seeing incredibly elevated volume, and bullish options flow is lighting up the screen. Traders are buying aggressive out-of-the-money calls, anticipating even further upside.
Yeah, the derivatives market is heavily tilted bullish.
But what's interesting to me is that they aren't moving in isolation. They are moving in perfect tandem with other surging drone and defense tech stocks like Kratos and Ondas.
And that sector-wide movement is a vital piece of the puzzle. It confirms this isn't just an isolated pump or a fundamental anomaly with one company.
Right, it's a macro shift.
This is a structural rotation of capital into domestic defense technology, driven by undeniable geopolitical realities and legislative protectionism.
That makes perfect sense. So let's gauge the temperature of the market, because it's not just retail traders chasing momentum. The analyst actions and quantitative scoring tell a very compelling story.
The institutional upgrades we've seen recently reflect a major shift in how Wall Street views this company's maturity. Looking at the timeline, in January 2026, Northland upgraded the stock, moving their price target from $18 up to $22 and assigned an outperform rating.
That's a solid jump.
It is, and they specifically cited the company's clear proof of scaling as the primary reason for the upgrade.
And then, just days ago, on March 3, Ladenburg-Thalmann bumped their price target from $15 up to $20, assigning a firm buy rating. When you have multiple institutional analysts revising their targets upward by 20 to 30% in a matter of weeks, it forces portfolio managers to take notice.
What is particularly fascinating about this specific setup is the slight disconnect in some of the quantitative data.
Oh,
Yeah, if you look at standard algorithmic ticker scores, the kind generated by automated sentiment trackers that scrape the web, they are flashing relatively neutral.
why the disconnect? If analysts are hiking targets by 30% and the stock is up 60% year-to-date, why would a sentiment algorithm spit out a neutral rating?
Often, those quantitative algorithms struggle to accurately weight rapid, geopolitically driven news cycles against historical volatility. They see the massive price swings and flag it as high risk, dragging the overall score down.
Ah, so it's a false negative.
Pretty much. Because when you manually review the top 5 recent news stories surrounding Redcat, they are overwhelmingly, universally bullish. They are all focused on the defense sector records being broken, the rally extending, and the impact of these geopolitical tailwinds. Human analysts see the structural tailwinds clearly, even if the generic quant algorithms are lagging behind the narrative.
And market perception at the ground level absolutely confirms that human sentiment. If you look at retail discussion platforms like StockTwits, the sentiment is categorized as extremely bullish.
The retail crowd is definitely on board.
And the broader sector strength supports this accumulation too. The XAR ETF, which tracks the aerospace and defense sector, is up 3.6%. That shows broad institutional accumulation, not just retail speculation.
Beyond just the stock price and the macro environment, the market is also reacting to very specific strategic partnerships. The one generating the most buzz right now is their partnership with Allen Control Systems, which falls under the Redcat Futures Initiative.
What does Allen Control Systems actually bring to the table? Because again, a drone is just a flying camera unless it has the software to back it up.
Allen Control Systems are specialists in autonomous tech. We are rapidly moving past the era of remote-controlled drones.
Right.
A remote-controlled drone requires a human operator, and more importantly, it requires a radio frequency link that can be jammed by an adversary. The military wants true autonomy.
Fire and forget.
Exactly. They want systems that can navigate without GPS, identify targets using artificial intelligence, and execute complex missions even in a fully denied electronic warfare environment. Partnering with Allen Control Systems accelerates Redcat's capabilities in that true autonomy space.
And that kind of software capability commands a massive premium in defense contracts. Speaking of future tech, the market is a forward-looking mechanism. What are the speculative rumors floating around right now that might be pricing into this current run?
The loudest rumor circulating right now is an upcoming, highly publicized maritime USV demonstration.
No.
This builds directly on the momentum from their February 27 Innovation Day. The market is anticipating that they are about to publicly demonstrate how their aerial drones seamlessly integrate with those Blue Ops unmanned surface vessels we talked about earlier.
The multi-domain ecosystem in action.
Exactly. If that demo happens and it's successful, it physically proves their multi-domain thesis to the Pentagon.
Look, a 60% run is great, and the narrative here is incredibly strong. But as the skeptic here, my alarm bells are ringing. We have to look at the flip side and talk about the risks.
Fair enough.
How much of this chart is built on actual, durable fundamentals versus just a temporary geopolitical fear premium? Let's get into the bear case.
Critical thinking is essential, especially after a run like this. What is the biggest red flag you see?
The single biggest glaring risk is geopolitical dependency. A massive portion of this recent rally is propped up by the market pricing in sustained conflict. If the Middle East sees a sudden de-escalation, if diplomats broker a sudden ceasefire, or the rhetoric simply cools down, that geopolitical premium holding up this stock could instantly unwind.
Defense stocks are notoriously sensitive to the threat of peace.
Exactly.
If the immediate threat diminishes, the perceived urgency for those unlimited munitions vanishes overnight. The institutional hot money will rotate out of the defense sector just as fast as it rotated in.
And it's not just the macro risks. There are micro, company-specific execution hurdles we have to address. I found a massive red flag in the data.
Oh.
Yeah, consensus revenue estimates for Redcat were recently cut by 20%.
Right, I saw that.
You do not usually see consensus estimates slashed by a fifth right before an earnings report, unless analysts are seeing a serious delay in contract execution or a major snag in supply chain scaling. How do you reconcile a 20% estimate cut with a stock that is breaking out to new highs?
You have to understand how revenue recognition works in defense contracting. It is incredibly lumpy.
Well, lumpy.
Yes. This industry is notorious for something called the valley of death in procurement. A startup can win a contract, but a delayed signature on a government desk or a continuing resolution in Congress can push tens of millions of dollars of recognized revenue from one quarter into the next.
So you're arguing this is merely a timing issue on the balance sheet, not a fundamental lack of demand.
The demand hasn't disappeared, it has simply shifted to the right on the calendar. The volatility surrounding those estimate cuts is likely already priced into the stock. The execution risks are real scaling. A hardware manufacturing line is always difficult, but they are heavily buffered by the fact that these are locked-in, legally binding DoD contracts.
That is a fair counterargument. The legal moat gives them a massive margin of safety on their execution timeline. Even if they are late delivering a batch of drones, the Pentagon can't just pivot and buy them from a cheaper foreign competitor.
Because the NDAA legally prohibits it.
Right.
The revenue isn't lost. And with the macro tailwinds blowing as hard as they are, the market is clearly willing to forgive a slight delay in quarterly revenue recognition in exchange for the long-term protection that the NDAA provides.
So bringing this all together for the final verdict, we've looked at the massive revenue projections, the impenetrable regulatory moat created by the NDAA, the explosive technical breakout on the charts, and the very real geopolitical and execution risks holding up the bear case. Where does this land in the final analysis?
Based on a comprehensive evaluation of the underlying data, the market positioning, and the upcoming catalysts, specifically the March 18 earnings report, we have an official bullish score for Redcat Holdings of 9 out of 10.
Wow, a 9 out of 10 is an incredibly high conviction rating. So what is the actionable strategy for the listener? How should they approach a stock with this much momentum?
Redcat is a high conviction long. For the active participant, we suggest a dual horizon strategy. First, there's a clear swing trade opportunity leading up to that March 18 earnings report.
Right, playing the catalyst.
Exactly.
Right.
You are riding the current geopolitical momentum and the market's anticipation of their scaling proof.
And the second horizon.
You transition that initial position into a multi-year hold. You aren't just holding for one quarter's numbers, you are holding to ride the massive macro wave of U.S. defense budget expansion.
Playing the long game.
You are investing in the reality that NDAA protections have fundamentally altered the competitive landscape in favor of domestic manufacturers, and Redcat is positioned at the very front of that line.
It's a fascinating setup, and the structural advantages are hard to ignore. Before we wrap up, I want to remind you, the listener, one more time. Please subscribe, like, and comment to this video to support the show. It really helps us keep bringing you these deep analyses.
It absolutely does.
I want to leave you with a final provocative thought to mull over on your own regarding this entire sector. Consider how these domestic protectionist policies, specifically the NDAA component restrictions, are quietly blurring the lines between the technology sector and the defense sector.
That's a great point.
For decades, tech companies thrived on globalized, borderless supply chains to drive down costs. Now, the government is essentially forcing a bifurcation of global tech. It forces us to rethink what truly makes a company a tech stock in the modern geopolitical landscape. If a company's greatest competitive advantage isn't their proprietary software code, but rather their legally compliant, entirely domestic supply chain, are they still a tech company?
Or are they something else?
Exactly. Or are they something entirely new, a sovereign infrastructure asset? Think about how that shift impacts valuation multiples going forward. Thanks for joining us, and we'll see you on the next one.